Amandeep Chopra, Group President and Head Fixed Income UTI MF, now joins in on the show. Great to have you with us on the show, Amandeep. To start off with, what's certainly going to be the priority of the next government is going to be, acceleration of growth. And from the three scenarios that perhaps there will be a status quo on growth, an optimistic growth scenario if we see policy incentives, or a pessimistic scenario where the growth slips further, where is it that you're inclined toward?
Our view is that clearly there will be some steps undertaken to, bring growth back in the economy. But one must be a little bit careful when, the new policies are announced, because clearly if the new government really starts to put in place a very aggressive pump priming, related policy to spur growth, then you will have inflation coming back in a big way. So I think the challenge for the new government clearly will be to bring Indian economic growth on a glide path which ensures that inflation doesn't come back. So a sudden spurt from current 5 to 5% GDP to a sharp spike up to 8%, I think will have a lot of concerns on the inflationary front.
How worried would you be with the El Nino phenomenon which seems to be developing now?
So this is something which I had highlighted in one of the earlier interviews with you on your channel. It is a concern because you still have a fairly tight liquidity condition of a high interest rate environment, and the expectation is that if inflation does come off, then you will see more benign interest rates going forward. Now a lot part of our retail inflation is driven by food prices, and with poor monsoons and impact of El Nino on crop output, you could see prices spiking again. You've seen that happen in the first quarter of this calendar, when you had unseasonal hailstorms, which actually led to a spike in food prices, which was reflected in the latest CPI data. So I think if you do not have a declining headline inflation, then clearly RBI may again be pushed into a corner where they'll have to start looking at maybe further rate hikes.
Amandeep, run us through what your estimate is when it comes to the overall inflation number, because of late the data readings haven't been all that encouraging and the core inflation number continues to remain high.
You're right. I think that clearly is a issue of concern, and that's one of the reasons where, in our view, we do not see the central bank actually looking to go dovish on its monetary policy. So I guess, that's largely being driven by the fact that you still have inherent core demand in the economy, and a lot of, input prices which were not getting passed on have started actually getting passed on. So some of the key indicators that we look at in terms of, bottoming out of operating profit margins of corporates, the price declines that we were seeing at retail level have actually more or less bottomed out. So clearly core inflation, remains sticky and will be an issue as we go forward. Our call essentially is that a good part of impact of rate hikes that we've seen over the last 18 months has already been reflected in the current inflation numbers. So going ahead, unless you actually start seeing some supply side debottlenecking, it's very unlikely that core inflation will decline significantly. And in that backdrop, again, we come back to our core premise that we do not see rates coming off in a big way, as far as the monetary policy is concerned.
So, Amandeep, where does this leave an average investor who wants to invest in the bond markets? If indeed there isn't any meaningful interest rate cuts, do yields continue to stay where they are or in a very tight, narrow range for the foreseeable future?
Yeah. So you're right. I think that's been our call for the coming few quarters. Clearly, we expect rates to be very narrowly range bound. We're not looking at any decline at all. So I guess in this backdrop, investors should be looking more at short-term, funds. They should actually be looking to focus more on income accrual and short duration funds rather than looking for, investing heavily into duration funds. But again, there's a caveat to that. Clearly we think that rates seem to be peaking off right now where they are. there is a possibility of it declining going forward if in case the new government really sets forth a credible roadmap for fiscal consolidation, and correspondingly you start seeing lesser supply of government bonds. So in that backdrop, you could see some bit of rally in the GSEC yields. And I guess it's very important for investors who have not added any duration at all in the portfolio to at least have a small allocation to duration funds. But predominantly the weightage right now still will be in favor of short-term bond funds and high income accrual oriented funds, which will at least ensure that since there is no expectation of a rate cut, you at least try and capture current levels of high short-term yields.
What is it that you're expecting when it comes to the currency? Because the appreciation was swift, but we certainly had trouble sustaining at those levels. And how do you see the FOMC meet outcome impacting the currency market?
So on the Indian rupee, we think will continue to be again moving in a very narrow band. There's been really very little activity post the initial level of appreciation that you saw. I think RBI is sort of intervening in the markets and will intervene further if required to ensure that it does not appreciate too much, and at the same time any depreciation I guess will be largely mitigated by the fact that you still are seeing good amount of inflows from FIIs. So I guess in this backdrop we're not looking at rupee moving beyond the the band that we had indicated earlier between 60 and 61 rupees. On the FOMC again, it's going to be again a very routine announcement. The QE rollback will continue, and on the currency markets we're not really looking at any significant impact.
Okay, Amandeep, so I'm just coming back to my question that I asked you earlier. What does one do if somebody wants to make a safe investment? I mean, is that 9.3, 9.4, 9.5% yield in select non-10-year maturities which are slightly illiquid a good avenue to invest in right now, or do you think these opportunities will be there even 3 months down the line?
I think you may not see any significant decline in the rates that you mentioned. 1-year rates, are again backed up to 9.25%, and this is for very liquid, very high investment grade, asset class like the certificate of deposits. So you still have fairly attractive, 1-year yields even today. 3 months down the line, we're not expecting it to, decline. So I guess, your decision today will be based more on, investing in 9-quarter today, or waiting for another 3 months and still investing at 9-quarter, where you clearly do suffer a 3-month loss of interest accrual. So my suggestion would be, that look at current level of 1-year and 2-year yields. These are good levels. We're not going to see a spike in that because, we are not looking at any sort of a rate hike from the central bank or tightening of liquidity from here on, at least in our realm of expectations. And in that backdrop, we see extremely stable and flat yield curve as far as the corporate bonds are concerned. So investors should look at investing between 1 to 2 year investment horizon. The levels are very attractive, and investors, like I mentioned earlier, who have practically no allocation to long-term bond funds, who have stayed away because of the reversal that you saw in the second half of last calendar, and have generally been wary of entering duration funds, should actually start looking at 10 to 20% allocation in bond funds. Because clearly, like I mentioned, we are in a environment where absolute yields are very attractive, closer to 9% on the 10-year, and going forward, there is a market perception that the new government in place will actually set forth policies which, over time, clearly not in an immediate impact, but over time, will ensure that rates do decline and the economy again goes back to a growth path of 7 to 8%. So I think in that backdrop, you need to position your investment portfolio to capture, some of that gain that you will see when the rates do decline.
Amandeep, it was status quo the last time around from the RBI's end in their policy. Do you think that given the fact that the downside to CPI and the inflation numbers have not been capped, that the RBI's endeavor to cut interest rates in FY15 will be limited?
That's right. Our expectation is that on the 3rd June as well, the central bank will, continue with its pause. There'll be no, rate action. But again, you have to look at it, you still have a couple of key variables which they need to monitor before they can actually even take a rate decision. One is that, in the June policy, the new government will be in place and they will hence, go forth with the new budget. So until the central bank is aware of the actual fiscal deficit numbers, the borrowing amount and other, policy initiatives, it will be very difficult for the central bank to preempt with any monetary policy action. Secondly, like you mentioned earlier, we still have the impact of below, trend line monsoon to play out on food prices. And that I think will be clearly a factor to watch out for. If it were to, lead to any spike in headline inflation, then again central bank may actually need to follow through with some, action. And that again will be something which they can only judge, later half of June, not in its coming policy. So I guess on the whole of it, central bank should more or less maintain status quo.